lot of where the value kind of accrues in the co-living ecosystem is to the real estate itself. And of course, real estate, with whatever it is, several $100,000 or several $1 million, you can create a big company that may have real sort of scalable operations. And that's an interesting venture investment. For me, my background is so much in sort of the asset heavy piece of it and actually owning and financing the real estate, working alongside operators and owners and investment managers to raise capital. And I just thought that skill set, felt like it was kind of missing in the sector, at least early days. And I think now that's less the case. But there's just so many dollars required when you're building these buildings. A single building, we're working on a deal right now that's $25 million ground up co-living development in LA. And that's, it's helpful, I guess, to have those skills in that network when you're trying to finance sort of larger projects. And that's where I'm hoping I can be helpful.
Christine here with the Co-Living Coach Show, also the founder of Kindred. Before we launch in, I want to also give a quick thank you. We are happy to bring this episode in partnership with AnyPlace. With the ever-growing demand for flexible living, it's more valuable than ever to find move-in ready housing that fits your needs and without the burden of long lease. Serviced apartments and alternative options like co-living make it super easy and painless to move, relocate, or simply explore a city. And we're honored to share with you the best platform to discover unique and affordable places to live in around the world. So I got called out on this already once. Somebody said, Christine, you say every episode is your favorite episode. And, they're right. However, this is definitely my favorite investor interview. I know we haven't had one in a while. So I brought on somebody that's more active in the co-living sector than anybody that I know on the investment side. He's invested in 3 different large operations, and he also consults with a bunch of other ones. So let me read his bio. Really excited to bring him on the show today. It was an incredible conversation. I know you guys will get a ton out of it. I'll read his bio and then we'll launch right in. Stoney likes to say that he discovered co-living by accident. He bought his first condo while still in college, and while he loved investing in and improving it, he discovered that living solo sucks and that life is better lived together with others. So he set an intention to combine his love of investing with his love of people to help create better collaborative housing concepts than those that had come before. The career idea was to learn the investment business working at top-tier firms in brokerage, investment banking, merchant banking, and private equity at GMAC, Macquarie Capital, Accord Group, and Cadre, all while continuing to explore and refine a thesis around which collaborative living models seem to work best. This inquiry led him down the paths first in co-housing, development of for-sale condos for preformed communities, on the property side, and then towards an angel investing in pioneering co-living companies like OpenDoor, Outsite, and Ollie, which we've had all 3 founders on our show. You guys can check those out. He is a board member for OpenDoor, one of the pioneering co-living operators based in Oakland, and a senior advisor to Six Peak Capital, a co-living focused private equity real estate firm based in New York City. Not that it matters much. Oh my gosh. So we have another very humble person coming on this week, just like Anil last week. This is very impressive. Stoney has degrees from Georgetown, Columbia Business School, and Insead. Currently, Stoney spends most of his time as CEO and founder of Nomos Group Holdings, an advisory and investment firm focused specifically on the co-living sector with the broad business objective to connect capital to co-living. So his energy and his optimism about this industry, you're going to just get it out of this interview. It's so amazing. I'm excited, really excited to have him on, and we'll launch right into it. So this week we have Stoney on with Nomos Group Holdings. You guys, I know we haven't had an investor on in a while. We've had a lot of amazing operators. But this week we are going to talk all about investment into co-living. This is the #1 guy. Reason being, he is already an investor in, and has been for a while, OpenDoor, which we've had Jay on the show. Outside, we've had Emmanuel on the show, and Ollie, we've had Chris on the show. So luckily, you guys can watch those episodes that, after this, if you haven't seen them yet. And then in some capacities, worked with Common Living. So welcome to the show, Stoney.
Thank you, Christine. Delighted to be on here. This is great. I'm a big fan, as you know, of all of the sort of forums and the work that you do. So happy to be included.
Yes, and we are grateful you are such an advocate for co-living and have been for a while. So let's start at the beginning. Like how did you get involved? How long ago?
Yeah, gosh, I mean, I've been interested in this idea of collaborative living for, gosh, since graduating from college in 2001. I mean, the backstory is I went and I sort of took some of my college savings and I went and actually bought a condo when I was studying at Georgetown in Washington, D.C. And it was a sort of a great financial play. It was much less expensive to have the mortgage than it was to pay for the single bed in the student housing in a nicer place. Um, and I really loved that element of it, sort of the investment piece, the improving the property. I sat on the board of directors of the condo association and sort of learned about how that community worked, but really discovered that living alone was just not my cup of tea, just lonely. And sort of when everybody else would cruise back from the bars to the dorms or their shared houses, I'd sort of go home solo. And I thought, oh, that's really not fun. So that was really, I guess, the seed of this idea around creating a better sort of collaborative living product for people post college, effectively like student housing for adults, I guess. And I just thought I really need to have all of the tools and the skills and kind of the network to be able to make an impact as I navigate that space. And so I went, I sort of became a real estate broker, just to really understand the sticks and the bricks and, how people make sense of value in San Francisco. And then thought, I really want to understand the finance piece of this. Went to Columbia Business School, focused on real estate finance and did sort of a minor in social entrepreneurship. And then went on to work in consulting, work in investment banking, became a partner at a small investment bank, gathering these tools and all the while kind of continuing on this learning journey around, what are the best formats for collaborative living. So I can tell you sort of about what that journey's been, but it started with co-housing, which was really sort of one of the first incarnations of collaborative living, I guess, in the U.S., brought over from Denmark by Chuck Durrett and Katie McCammett, who I spent a lot of time with early on and who I'm a giant fan of, and actually invested in some land and some projects on that front. And then, fundamentally, read an article about this co-living concept. I guess it was in 2013 that Ben and Jay were working on at OpenDoor. And I just called them up out of the blue and I said, guys, I've been wanting to do this for, a dozen years. How can I be helpful? How can I be involved? And they said, well, we're raising some money. Would you like to be our first investor? I said, absolutely. So long answer to a short question, Christine, but that's kind of how it evolved.
No, that's amazing to hear that journey and how long it's been, right? So you're super passionate about, and you've lived it. And the investment banking background, which is so funny because some of the large operators, that's their background. I know we're going to have Anil on the show with Node Living, and that's his background. His episode's coming on sometime, I think this month or next. And so, yeah, I think that's a great background to have, that investment banking background, and alongside of real estate and knowing that. Like, do you find that to be true?
Well, I mean, absolutely. My sense is that, early days, I think it was really about sort of experimentation and proving that you can get a bunch of people to live together and have that be a really positive, sort of nourishing community. And equally to prove out that it actually works from a real estate perspective. I mean, we were generating dramatically higher yields, by running this co-living concept, I guess, in originally old mansions in kind of Oakland and Berkeley. But I think what, my discovery was that while it's angels and venture capitalists that are willing to take risk on a new idea, my thinking is that a lot of where the value kind of accrues in the co-living ecosystem is to the real estate itself. And of course, real estate, with whatever it is, several $100,000 or several $1 million, you can create a big company that may have real sort of scalable operations. And that's an interesting venture investment. For me, my background is so much in sort of the asset heavy piece of it and actually owning and financing the real estate, working alongside operators and owners and investment managers to raise capital. And I just thought that skill set, felt like it was kind of missing in the sector, at least early days. And I think now that's less the case. But there's just so many dollars required when you're building these buildings. A single building, we're working on a deal right now that's, $25 million ground up co-living development in LA. And that's, it's helpful, I guess, to have those skills in that network when you're trying to finance sort of larger projects. And that's where I'm hoping I can be helpful.
Oh, and that brings up a good point, because the one I've told everybody this, I've heard it from operators around the world more than anything else, was the master lease. They're all having a hard time. It was a great idea when it was like 100% occupancy and you could scale quickly. And now they're really wanting to convert either like a management fee or profit sharing or buying their own building if they can even do that. But, once things become, if real estate decreases and there's distressed properties, maybe we'll see that happen. So what are your thoughts on that? Because you've kind of seen both sides.
Yeah, it's funny. Again, I see it really as this kind of evolution of the sector, right? Which is, I think that the master leasing approach was really appropriate early days, because it's like, no landlord wanted to take the risk on necessarily this exciting, innovative idea. I mean, we had 16 people living together in the farmhouse, at OpenDoor. And I think, you could find a few landlords that would take the risk, but they were like, we just want the rent and you guys need to figure out, what happens sort of thereafter. And so I think to prove it out, it was really valuable. And I'm 100% in agreement with, and have always actually sort of early days been an advocate for, the management agreement sort of approach and sharing that risk with the landlord. And then also allowing the landlord to participate, right, in the upside of co-living, which is like a really exciting, higher yielding, opportunity. And so I think sharing that, and that's also comes from sort of a collaborative philosophy, right? I think you should be working in partnership rather than in sort of a, across the table kind of a way.
Yeah, very transactional with the landlord and the, yeah, you're right. And so, if somebody's going to sign, 10-year master lease, the landlord's probably very happy. But so, to that point, I guess what kind of ROI as an investor, ROI are you looking at?
No, it's a great question. I think really the way I think about it, to be honest, is because every market and every submarket is so different. I think of it as a spread over traditional, apartment buildings. And so I sort of go, you probably want to be earning 100 to 200 bips of uplift for running this co-living concept. And I see it as, not dissimilar to sort of senior housing or student housing, where you should be in exchange for taking some additional operational risk, which is, it's at the margin more complicated than just kind of renting out apartments, and more, programming and certainly some capital investment in the property to make it really sing from a community perspective. Again, the way I see that is really as, because every market and every submarket is so different, I think that you do want to get paid as the owner some sort of an uplift versus traditional multifamily in exchange for taking that operational risk. So I really see that as 100 to 200 bips of uplift. So if you're operating in, it is a 5 cap rate kind of a market, I think you want to be earning, a 6 if it's a light lift, backward compatible value add kind of a deal. And I think you want to be earning something north of 200 if you're going to be taking a lot of risk in terms of development and reformatting the building, or if you're doing, real kind of ground up purpose built stuff. So, you'd want to be approaching a 7 if you're in a 5 cap environment. Now, most of the urban centers, right, where we're investing, LA, Seattle, San Francisco, New York City, those are markets where for traditional, multifamily and good locations, it's really more like a 4 cap or a 4.5 cap. And so I think to answer your question, in many of the markets, I think you want to be targeting something north of a 6 in terms of an unlevered yield on build cost.
Awesome. And then back to the management agreements. And again, I know we're in the States and we have people from around the world listening, so we'll just stay in the States. I think like what kind of percentage is the management agreement typically? I think a property management, multifamily, even some co-living, I've seen 10% management fee. What have you seen?
Yeah, gosh, I guess coming from my more sort of, previous background, the very big managers, guys like the Gray Stars of the world or whatever it might be. I mean, they're charging, between 3 and 4% on revenue. And I do think actually some of the largest co-living groups are migrating that direction, where they're just saying, okay, what we want to do is really be a solution for a large group of sort of institutional owners. And therefore they're kind of indexing toward those numbers, that kind of 4 to 5%. Certainly early days, to see 10%, to see 15% was not unheard of. And to be honest, a lot of it also depends on where those staffing costs fall. Are they happening remotely at a headquarters? Are they happening on site in a much more intimate kind of an environment, like at a place like OpenDoor? So I would say it's a really wide range. And my view on the sector broadly is that that's appropriate, right? Because, some brands will really resonate with, people that want a very intimate, very sort of holistic, crunchy, if you will, kind of an environment. And others will want, something that's a little bit more, what do I want to say? A little less intimate, a little more, it feels a little more like traditional multifamily. And so I think that will, inform the metrics on what it costs.
And I'm glad you brought up a good point, and I agree with that too, is the, backing up a little bit, is the fact that we had to prove the model. Like, you're right, these landlords didn't get it a couple of years ago at all. And so you had to do a master lease in the very beginning to kind of prove the model and get some headway. I mean, even to the early 2017, we were looking for a big home in Los Angeles for Kindred Quarters. And I called 40 different I talked to 40 different landlords, for their, went on
Sure.
Craigslist, all these rentals, one by one. And, my assistant at the time, she's like, oh my God, how do you take that many no's? And I'm like, well, I'm just going to get to the yes. And it
It's
was
part
hard.
of being an entrepreneur, right?
I don't mind it. And so hearing no a million times. And then finally 41th call, he was a very successful entrepreneur. It was a rental property. He's like, and I explained co-living because he'd never heard of it, of course. And he's like, I love it. What a great idea. Let's do it. And, we did a 3-year master lease there. And so I think you're right in that sense that, like, a lot of us had no choice. But now, it takes a pandemic to realize, like, what happens if occupancy drops? Then we're in trouble. So yeah. So let's touch, of course we have to, what are your thoughts, kind of what have you seen in your current portfolio, amongst all these companies? You don't have to say any of the names specifically, but, how are they powering through this pandemic?
Yeah, gosh, I mean, the thing that's been really encouraging for me, and I think, to be honest, early days, we kind of went, co-living is kind of the opposite of social distancing, right? And so I think that it really suffered, in everybody's mind from kind of a perception, issue. I think as it's evolved, what we've learned, right, is that many of them, like Common, for example, who I'm, doing some work with at the moment, the units are 6 people to an apartment. And so you're really sharing, and that's like a family, right? And so you're going, okay, well, I'm not necessarily, early days, I think people really did kind of quarantine in their rooms and tried to really limit interaction, even within their own kind of small unit. And I think it's evolved. They've really seen that as a family. I mean, I'm living here with my family. We have, 5 people in the house, and certainly we're not social distancing, and I think that as a antidote to the loneliness that you would be experiencing otherwise if you had truly a studio apartment and had to quarantine there, for weeks and months on end, I think that would be pretty grim. Or even, to be honest, living with Craigslist roommates, right? Where you don't have kind of the frameworks and the architecture and the protocols in place to really communicate, and where there hasn't necessarily been a really thoughtful overlay about how do you, cultivate a healthy culture. I think that there's, the possibility for that to not be nearly, as nourishing as co-living. In terms of the actual metrics, right, which is where you go from an investment perspective, it's been very, very defensive, which is really, I think, exciting. We've had, within the Common portfolio, and hopefully I'm not oversharing, on Brad's behalf, but they've had very, very low delinquencies, sub 5% across sort of April and May, versus up to 20%, in the broader multifamily market in the US. And so I think that is really encouraging. People are paying their rent. Occupancy is still very, very high. And you know, these are truly sort of the mid-market affordable option within, you know, within their cities. And so you sort of go, okay, if I'm paying less for my rent, that gives me a little more flexibility if there's volatility in the income, you know, whereas I think that, you know, some of the stuff at the really higher end luxury end, you know, could well suffer. So that's been, like I say, very exciting that it's been so defensive versus traditional multifamily from an investment perspective.
Yeah, I mean, those are amazing numbers. So I don't think Brad will, I think he's probably fine sharing those. And I think that was the advantage of co-living being at like, you know, 97 to 100% occupied with a waiting list, is that if you were already full and people couldn't really move, a lot of them couldn't move unless they were international, then you've stayed full, right?
Yeah,
And
and some of them have actually seen increases, right? Again, hopefully I'm not oversharing on, you know, I guess Greg's behalf, you know, at Ollie, but I mean, in their Pittsburgh property, they had a fairly dramatic jump in occupancy. They were already, you know, well into the 90s, but they went to, I think, 98%. And that was because people had to leave their dorms. I think it was at University of Pittsburgh or Carnegie Mellon or one of those. And so they said, well, gosh, where are we gonna live that's still within the realm of affordability and where we actually, you know, have a bit of a community during this crisis. And so that the occupancy actually jumped, you know, there, which is, again, and it's just an encouraging anecdote.
No, love it. Love it. And we love, again, Star City's coming on too. We're having amazing interviews coming up, you guys. Summertime interviews. And same, he gave all their metrics, like John did, just all. And it was so impressive and so, you know, and of course they just raised a huge round. So I'm sure that helped too, you know, like prove the model, like, hey, investors, like, look at what's going on in this sector in a positive manner. So I'm elated, obviously, that, you know, we knew the recession was coming. We didn't know a pandemic was coming.
Yeah, that's right. And I think many of us, to be honest, on the investment side, have been sort of waiting for something to happen where there'd be a moderation in prices, right? It's just very, very hard to put dollars to work at the top of the market, right? And we have been in such a long cycle that I think some of us are kind of breathing a sigh of relief that this is now happening and that there's going to be an opportunity to really scale this thesis in this sector in the context of having some prices that are a little more, I guess, approachable, you know, for buildings, land, you know, development site, potentially construction costs coming down a little bit. Who knows? And I'm a big fan of John and everything they're doing as well. So
yeah, no, it was a great interview. It was fun for sure. And I love, you know, obviously you've niched down to co-living, but I love how diverse you are in the different verticals, you know, OpenDoor, like you said, and again, Jay's amazing. And I love their concept. You know, it's like it's a big house with a bunch of people in it, but they're very close. They're like a family. And then you've got Outside where it's like global, around the world, digital nomads, like completely different model. And then, you know, Ollie being more, you know, the buildings and larger scale. So like, what are some, you know, again, you're kind of across the spectrum. Was that by design?
no, I mean, no, I don't think so. I think it's just sort of being very curious and learning. And a lot of it for me is about people, right? And what their vision is and how you connect with them and, you know, sort of building trust and all of those types of things. And so as I met those various entrepreneurs, I just felt like these are the guys that I want to be on this journey with. I mean, that's been very, very, you know, fun and exciting to be part of the journey Ben and Jay are on. I'm now on the board of directors of that company. So I have the opportunity to, you know, hopefully provide some strategic advice or direction as they continue to grow. They've been on a very sort of organic, you know, slow growth, very, very sustainable, very responsible approach. And really because I think they feel very strongly about preserving, you know, the culture, not only of the company and the broad community that they've built, but of the individual communities within the houses. I think, you know, when you look at the future of co-living, I do think it goes more, and that would be in order that I did OpenDoor first, then Outside to sort of go, how does this look as you think about it globally, right? I think they're in, you know, 18 cities around the world and 25 individual properties and sort of continuing to scale. But I do think that, you know, where hopefully I can play a role is in continuing to institutionalize this sector and really bring to bear large investment dollars. And I think that requires, you know, and I think Ollie is one example of that, where it really is at a very large scale. I mean, I want to say it's, you know, 400 bedrooms in the Alta project, you know, several hundred in the Pittsburgh, you know, project. And I do think that what will happen is, just like in student housing, as it becomes, less of a kind of a entrepreneur-led and mom and pop kind of a led idea, and more sort of professionalized, institutionalized, I think that the opportunity for very large investors to, to come into the space is there. And I think for them, it's really meaningful, right, to achieve this 100 to 200 bips of uplift. And if you put that in the right sort of a structure with a, sort of a private equity real estate style structure, and it depends on the investor, right, whether they want to be a long-term investor, whether they want to be thinking about, sort of tax and, refinancing and, trading and multi-generational elements, or whether they're really sort of more focused on IRR and, building something, stabilizing it, and then selling it. But if you put it into that kind of a more traditional private equity real estate structure, it's actually a fairly meaningful uplift in terms of the IRRs that you can achieve as you stabilize these things. And, hopefully as cap rates, over time, sort of converge as they have with student housing, toward the more traditional multifamily style cap rates.
Awesome. No, that makes sense too. And it's funny, you are like the most involved person, I think, in co-living across the board. Because I know you do investment advisory services for co-living. And I know you just had a big announcement last week because you're the senior advisor over at Six Peak, right?
Yeah, absolutely. I mean, that's right. I mean, well, when I sort of left my last, private equity role, which was at Cadre, also a sort of a very forward-thinking, sort of tech-empowered, style platform, I went, what I want to do is really be involved, having made these, angel sort of seed investments in the operators. I said, I really think there's an opportunity to kind of bring capital to co-living in a more meaningful way. And so I guess I left now, gosh, almost 2 years ago to create, Nomos. And again, the idea there is really, and this is a lot of what we did when I was at Macquarie and at Accord Group, which is the, where I was a partner, is help really capable operators and investors. In the traditional private equity world, we call operators like, it's not operators like the ones that do the co-living operations. We think of them as operators being developers or local sponsors that are, finding deals, raising the capital, et cetera. And I just thought there's an opportunity to kind of bring some of this more, global institutional thinking and some of those frameworks to those operators and effectively teach them, how to be institutional investment managers. And so that's really what Nomos is working on. And I think the second part of the question, which is around Six Peak, I mean, those guys are really the ones that have leaned into this thesis. I mean, there are 3 people that come from, investment banking backgrounds, family office backgrounds, corporate private equity backgrounds, and then sort of successful entrepreneurial startups. And they've, been working alongside, much more kind of institutional family offices, fund of funds, private equity style allocators, and, really leaned into the co-living thesis. And they've invested in, now I want to say 21 different opportunities, which have, over 1,500 beds under development. And so I just couldn't be more excited to be a part of that organization as kind of a senior advisor, sitting on their advisory board and helping them think through some of those capital markets.
Awesome. And I know you kind of just answered the question, but like what else is in the future, for your investment portfolio?
Yeah, gosh, what would I like to do? What's in the future? I think that, there's going to be a focus, I think, in the short run of really trying to do deals that are, what I want to say are kind of too big for high net worth individuals. It's like, bigger than sort of a $5 or $7 million deal, but probably too small as of yet to really be capturing the attention of big institutional investors like the Fortresses of the world or the Angelo Gordons or the Blackstones, or whatever it is. And so I think that, particularly as the market kind of moderates, there may well be an opportunity in some of these great urban centers to buy either land or to buy into conversions, where you're densifying those buildings, creating better, cozier spaces, overlaying the operating system, and adding value that way. That's in the short run. I think over the really long term, The areas where I'd like, I mean, this is something I know we've talked about before on the co-living forum, but this concept of potentially converting hotels into co-living. I know there's a lot of regulatory issues to kind of navigate in that space. And then one day, if I am sort of thinking very blue sky, well, I guess the evolution, the probably before the even more blue sky one is I would like to, over time be doing more investing directly, whether that's in, startup real estate private equity managers, whether that's in sort of, very, very selectively, maybe still in operators, and certainly, directly into deals where I am investing today. I mean, like I say, the deal we're working on now in LA is $25 million. So falls exactly in that space. So I'd like to, over time, have more discretionary dollars to put into those kind of opportunities. And the very, very sort of blue sky stuff is I'd like to, 7-10 years out, try to figure out ownership so that ownership can be dispersed more widely. That was kind of where I started on this journey of how do you allow people to own the place they live and participate in the exciting investment thesis that I love in a way that's approachable, right? Because, it's hard for anybody to cobble together these huge dollar amounts, and so when you have whatever the right number is, 80,000 or 150,000 or 250,000, you can afford something to buy it to get in the market, but it's a studio or it's a 1-bedroom in these dense urban centers. And that's lonely. And so I'd love to figure out how to have some kind of a collective ownership structure over time. And that's just in the ideation space at the moment, I would say. It's going to take some time.
Stoney, please do this fractional ownership sooner. I've been preaching it for 2 years on this show. I'm probably driving everybody
I'm
nuts.
so excited by it. And I, of course, talk about it with all the various operators and owners. But there's just mechanically, we'll have to, really spend a lot of time, I think, figuring out how to do it.
Yeah, there's going to be a certain corporate structure, so everybody invests into that, and then you've got some people are kind of whispering about it and kind of trying to figure it out, but I don't know if anybody's super serious yet. So yeah, I think that's an amazing model. If you have 16, OpenDoor, for example, you have 16 people in the home, and they live there a pretty long time.
They do. I mean, they have very long sort of occupancies. I mean, because people really, it is their family in many ways. I mean, we've had people living there for 3, 4 or more years. And it's really great to go back, every once in a while and check in, and it's the same faces and hearing about how their lives have evolved and their businesses have evolved. And, it's really great.
No, that's awesome. So yeah, if they could contribute to, a 30-year mortgage, each of them contributing to the payment each month and then having some sort of ownership in some way or however you'd structure it. But yeah, so yeah, I hope not 5 to 8 years out. Hopefully sooner.
Yeah, well, always happy to keep talking about it, Christine, as well. I'm keen to connect with others that are thinking in those terms.
Awesome. Good stuff. Cool. And then, and I have one more question for you, but, Stoney's come on, we have that weekly forum that I've been telling everybody about. We just had our 8th week on Wednesdays, and he's been on most of them, which is amazing. Because of course there's operators on there that have questions on the investment side. So thank you for joining us on those. And that's how I found you originally. So that was cool to have you on. And I'm like, you have to come on the show. Like, you have to talk about all this. So my last question, I love that you just explained the future of yourself and kind of the investments. Where do you see, so if we fast forward 10 years, where do you see the future of co-living as an industry, in the year 2030?
Sure. I mean, I think it's going to look a lot like, hopefully not overly simplistically, but, I think it's going to look a lot like student housing or like, senior housing, where you have very, very large institutional investors. I think that there will be, there's a lot of discussion or, sort of conversation always about, will there be a few big brands that sort of own the market, or will there be lots and lots of little brands in terms of, the actual operations? And I think it'll be both. I think just like in student housing or in senior living, it'll be a multi-billion dollar subsector of multifamily apartments, and I think it will be truly institutional if we look at sort of a 10-year horizon. I think that those people that invest in the space today, if they've got enough time to kind of get through the current recession and not have to exit, I think there will be giant value creation. I think, and I do think that you'll have sort of the biggest, best, sovereign investors in the world coming into the space. And that was the group that we worked with a lot, when I was at Macquarie Capital, both in New York and Hong Kong, large Middle Eastern investors, large Canadian investors, large Asian investors. And so I think that's on the ownership side. I think that's all going to happen, and that's going to, and hopefully I can be helpful in trying to put together the right structures that makes that sort of comfortable, from a risk perspective for them to actually put those kind of dollars to work. And I think that they'll sort of stair step into that. On the operator side, I do, as we were just saying before, I think there will be some big ones that have, like a sort of like the hotel world, right? I think there will be like sort of the Marriotts and the Hiltons and the Hyatts that really figure out scalability and really figure out, how to have it be a very similar experience at each of the individual properties, sort of wherever you are, and that will have its own network effects. I also think that there will be sort of the ace hotels, and there will be these other sort of more wonderful, more funky, more geographically focused, more, sort of specific, types of operators. And I sort of welcome all of that. I think that that's going to be exciting, and I'm happy to work with each of those different types. And of course, it'll be global, right? I mean, this is happening all over the world, as we see on your forum. And that's what's so exciting for me, is to sort of, where the rubber hits the road, kind of hearing from operators and like, what are, some of the challenges and opportunities that they're confronting in their own markets. So that's where I see it. I mean, I really see this as like, a sort of a 20-year career trajectory just in this very specific sector, because I think it will be so huge.
And then, so obviously it's going to be an official asset class eventually, hopefully soon, similar to student accommodations, right?
Yeah, that's right. It's funny. I often have this vocabulary discussion with friends of mine. I keep referring it to as a sector, because I think of asset classes as like stocks, equities, bonds, private equity, alternative investments, that kind of thing. And so then when I think of real estate, I kind of go, oh, there's 4 food groups, and that's retail, industrial, multifamily, office. And then I kind of go, okay, then there's these subsectors. And so I think of it as like, that's sort of a vocab thing, but without doubt, it will be its own thing. And there will be investors that, that are focused on this thesis, because I truly believe it is a better risk-adjusted return in many, many ways than some of the products that are already out there. And that it's something that there's clearly a giant demand for among residents, and when it's when it makes more money, I'm hoping there will be a giant demand from investors as well.
And you practice what you preach. You're in it. You're in the trenches with the operators.
That's right, with the operators, with the investors, sort of across the spectrum. And I love it, right? Because it's the people that you meet in co-living are generally very collaborative, very nice, very sort of future forward looking people. And so that's exciting and energizing and nourishing. So
no, and even the weekly forums, I mean, again, people from all around the world sharing, being honest, but then you'll have 3 people from New York City, which are direct competitors, on the forum, still sharing. So I think you're right. This industry is more of a community itself with even the operators, which is awesome to see that.
Well, and it's a rising tide, right? So I think everybody's going to win if you're involved at this stage. I think there's just a lot of opportunity.
Yeah, I think the pioneers have to stick together so they don't get the arrows in the back.
Absolutely.
Yeah,
absolutely. Right. And it's just like, from an efficient markets perspective, like fundamentally you always want sort of more money to be coming in, because like, as there's more money coming in, as there's more operators, as there's more sort of synergies within the whole ecosystem, everything is worth more. Because your cost of capital goes down because it's less risky, and so I think even from a just purely economic perspective, we should all be helping each other. We're creating this industry together. And that's very exciting.
Yeah. And again, when you talked about the hotels, the Hyatts, the Marriotts of the world, do you see roll-ups happening in M&A?
Yeah, absolutely. I mean, I think whenever there's these sort of ebbs and flows, it's just a question of, how people have capitalized themselves and, how they've seen the specific opportunity and how they can capture it. And some dollars are more short term and some dollars are more long term. And I do think that there will be a real opportunity for kind of M&A that can be really win-win. Like I think, there, a lot of it has to do with the cultural synergy always in M&A, right? There's in business school, you kind of always do these case studies where you go, oh, well, culture is often what sort of dilutes the prospective value of M&A. And so I think a lot of it is about sort of matching up and finding chemistry with people that you do want to work with. But I think economically, it could make a lot of sense, and to have better scalability within some of those businesses and sort of better efficiency, and wider geographic footprints, and a lot of those various things. And so much of it, right, can be scaled, some of the tech pieces, the marketing pieces, the leasing pieces. So yeah, and I like I say, I think that can be good, for everybody. And I think there will be some consolidation in a downturn. That's kind of often what happens, and then that sets the stage for another growth cycle and for more sort of creativity and more innovation.
No, definitely. Great points. And that brand consistency, right? And that experience consistency where you can go to any, if you're going to the same brand around the world, what you're gonna, it's just anticipated what kind of experience you're gonna have, and the brand loyalty. The other thing needs to be these rewards. I'm surprised there's not loyalty rewards happening yet. Kind of like, again, with the hotels. Do you see that happening in co-living in the future?
Yeah, it's interesting. My only real perspective on kind of the short stay stuff is through kind of the lens of Outsite. And certainly Outsite has set it up so that you have a membership. And as a result of that membership, right, you are at a discounted rate versus just kind of coming in and trying to rent a room. And they're quite careful about, how they curate the communities within these small houses. So it's not really like you can just come off the street and kind of bang, rent a room. But if you have, indicated a sort of more of a commitment through the membership, then it is on a per night basis, cheaper. And it's been interesting to look at Outsite in this COVID world, because you're like, well, gee, hospitality is having a horrific time. But if you sort of, so remote work is really having a moment, right? So you sort of go, okay, hospitality is having a really tough go at the moment because, of course, people couldn't get on airplanes and, didn't want to stay in hotels and all the rest of it. Remote work, on the other hand, I mean, Outsite kept their buildings open the entire time during COVID because that is your shelter in place. If you're from Sweden and you're, a digital nomad and you're, a creative director, whatever it is, you send in your work from wherever, you're not going to get on a plane to go back to Sweden, right, on March 20th. And so people were truly sheltering in place, truly forming these communities and these cultures, which were, again, intimate, right, where you are sharing space, I think, with, this 5 other people there or 6 other people there. But where you can really truly work remotely because they are set up to have workspaces and fast Wi-Fi and all the rest of it. And so that has been, I think, really positive, in terms of their business model. And I think that, hopefully there will be an opportunity for them to continue to expand into that interesting demand for the product. And I used to stay at Outsite a lot also. And it's just such a neat hybrid between, not having to truly have a second home somewhere, but truly feeling as though you have a second home somewhere. I'd stay in the Venice one all the time. I was working very closely with a family office last year that was based in Venice, and we were spending a lot of time sort of back and forth. And I literally had my room, I had my bathroom, a shared bathroom to be fair. But but it was a home. I really felt at home when I went back to my place every night. And that's cool, versus a hotel. And I tell you what, it was a lot more cost efficient as well.
No, I've stayed at their Venice.
And I do think there'll be more and more of those memberships.
Oh, for sure. I've stayed at
Dell, or which one were you? They've now got like 5 Venice properties. I mean,
yes, I can't remember which one. I was about 1.5 years ago. And then I've seen their San Diego. I've been to their San Diego. So yeah.
Yeah. And they've got the shared bicycles, and they've got, it's really like, it's well set up, and a lot of fun.
Definitely. Well, awesome, Stoney. Thanks again for coming on this week. Really appreciate it. I'm sure our viewers and listeners also appreciate it. Again, coming from just this investment background and perspective and understanding the sector so well. So thank you again.
Well, thank you so much, Christine. And thank you for all of the sort of connectivity and all of the forums that you put together and kind of creating this space for all of us to collaborate online, during this time. So very grateful to you.
Of
And
course. Well, I appreciate that. Thank you. Thank you so much for checking out today's episode. If you want to learn more about co-living, you could check out my book on Amazon, The Co-Living Code. And of course, if you're looking for the perfect software to power your co-living concept, check out kindred.io, KNDRD.io. And another quick thank you for our partner, Anyplace. They make it easy to book a flexible, fully furnished accommodation anywhere around the world, whether it's an apartment, co-living space, or hotel. Check them out at anyplace.com.